Good afternoon, ladies and gentlemen. This is Jeff Halley from OANDA Singapore, and this is the weekly precious metals and commodities video. We're going to run through the CFDs that are available on the OANDA FX and CFD trading platform, and have a little discussion about the markets and perhaps give a bit of an insight on what I'm seeing on the charts. It's been a very, very quiet few days, to be honest. A lot of sideways trading. That should pick up as we move further into the week, as the data intensity picks up and we get more clarity, hopefully, on the passage of the US tax reform bill through the houses of Congress. Let's get straight to it and look at gold. And actually, overall, gold has been in a range trade. A lot of noise since the late part of October, but when we actually take a step back and take a cold hard look at everything, we've really been stuck for quite a while now in a 1260, 1291 and a half range. The two key areas here, 1291 and a half, I'm circling here as a double top, a daily double top, followed by 1296 and a half. And down below, this key level here is around the 1260 level. At this level, looking at the positioning still in the futures markets over in North America, this will be the level I feel that a lot of longer-term bullish traders will look to cut their positioning and either throw in the towel or start to go short. In between, we do seem to be pivoting around the 100-day moving average, this red line. And at the moment, over the last couple of days, we've fallen as the dollar strengthened and US yields, and the 10 years particularly, rose 6 bips to around 2.4. And we've been butting up against this line ever since. Is quite a bit of support though just below. We've got this little trend line here that comes in at around the 1267 and a half level, followed by the 200-day moving average, this blue line at 1263.76, and of course that 1260. I think we're going to have to get some more visibility on the direction of the dollar though before we get more visibility on the direction of gold, because gold seems to be completely one-for-one correlation at the moment with US dollar and by default US yields. Looking at silver, bit of a sort of a story, but perhaps not looking quite as grim, I would say, as gold. We've got this trend line that dates all the way back to early July. We've almost tested it at this level, and we have 2 or 3 tests here and then another 2 here. So this has got a lot of action points on it, and it is held beautifully. Today, this support line comes in at 16.83, we'll call it 1683.20, and that is just below the 100-day moving average at 16.90. Silver itself over the course of November has really just made a lot of noise sideways between the 100 below and the 200-day moving average above. Above here, 1729.45 is a daily double top, followed by this high on the 10th of the 16th of October at 17.47. So there is wood to chop on either side for silver. The range is definitely contracting, and that would perhaps imply that we are going to get a breakout. I think the key is this trend line, supportive trend line. If it breaks, then that would imply that we are going to have a test towards the bottom of this range. Otherwise, if we can get through the 17.29, it does look like an ascending triangle. That would set us up potentially for a break of the base of the triangle. So we're looking at probably about another 80 cents there, so possibly we could move up into the 18 level, which coincides with these previous highs from September. Platinum. Platinum itself, I've been calling the English patient or the ugliest dog in the glue factory for quite a while. In fairness to this most maligned precious metal, which seems to be suffering more than most, it does seem to be attempting, a bit like silver, to make some sort of recovery, albeit a very slow one. We can see a series of higher lows here over the course of November, and they've all come together to form quite a nice little trend line support. The market's trading quite close to that today. This is at around 928.40. A break through this level would suggest a test of this first support area around 927.60. But then through there, it does actually open up a lot of clear air. And in fact, you could possibly call this line, this level here, the 27th of October low, 910.70 support, and then of course this key 903.85 region. Up above we have the 100-day moving average. We have at 944.60. We have resistance at 946.15, which is a 1, 2, 3 triple top, and then we have the 200-day moving average at 951.20. So all in all, there does seem to be quite a lot of wood to chop on both sides of the market. The danger is that we do break the support line, this trend line support, and drop back towards the longer term support. But otherwise, it's as steady as you go, ranging market. Palladium, which is certainly not the ugliest horse in the glue factory by any measures. It's had a fabulous run this year, being up nearly 100%. We finally cracked 1,000 again last week and raced up to 1,027.5. Thereafter, it has actually started dropping again. Probably not surprising given the amount of the move, the amount that the metal itself has rallied. Some profit taking would be to set in. This recent trend line, which dates back to early March, which has held Palladium beautifully over the last 6 weeks, is actually, Palladium's actually flirting with this today. We almost closed below it last night. We've had a look below it this morning, and in early European trading, it has moved above it. I think if we break this line, which today comes in around 993.80, that would set us up for a potentially short-term correction in Palladium. And my nearest support really is the 100-day moving average, which it hasn't really seriously tested for nigh on 6 months now. So possibly some of this noise around this 948.70 level, but really I think this is the first major support, followed by this 906.80. Let's just zoom out on Palladium and just see the scale of the up move. And we can see this long-term support line here, and it goes all the way back to October last year. This is our key level, and this is definitely still a bull market from a technical perspective. And until this 877.95 level breaks, and it's almost coinciding with the 200-day moving average now. Until we get down through this, 877 level, I think we still have to consider Palladium in a bull market, and any break of this trend line above the small short-term one is probably implying that we're having a long overdue short-term correction in the general bullish trend. Let's go to copper. Copper was quite interesting. There does appear to be a bit of a triangle formation on copper at the moment. Let's just blow this bad boy up. So I've drawn this on today. Fiendishly difficult with this charting package actually, but I do suggest that you all try it. It is actually very useful for highlighting these triangles. We can see here that we're just abutting the top of this triangle. It could go either way from here, to be honest. It does look like it does actually want to test higher, but actually it's a very, very nice technical formation, and a break and a daily close through the base of this triangle, which is at 305.25, would imply that the length of this triangle, its vertical axis, and we're talking here at about 17 cents. It would imply that we would move lower by 17 cents from here, which would take us down to around about the 288 level, so somewhere around here. Of course, there is some wood to chop through here. This series of highs now becomes support at 297, 100-day moving average 294.75, 290.5. This series here, this congestion zone here, 284.70. Quite a lot of support technically for copper on the downside here. Upstairs, the obvious resistance is this previous high at 322, and then the Then the 16th of October high here at 324. Let's start looking at some of the energies now, and finally, after what seems like forever, to squish this up, we've actually seen some movement in natural gas. It has actually been up and tested the top of its range and formed a nice top around here actually. There was a cold spell in the United States last week. We are running towards the season in the year where gas demand normally picks up, and this is what you can see here. We can see these huge moves. That was some sort of 5% up over the course of one day, and then we've seen a series of higher lows each day. As the weather deteriorated in North America, traders have bought natural gas in anticipation of demand going up, and it looks like, looking at the forecast, that maybe winter's going to arrive a little bit earlier, and there has been a big drawdown in actual natural gas in storage in the States, both over 2016 and 2017, and they are anticipating again a drop in inventories in 2018, and that's been quite supportive of prices, only to a certain extent though, because we still have not broken out of this long-term range. 315, 275.50, both of the key levels. When all is said and done and the noise subsides, we have still not broken out of that range. This would be more of a correction back after a huge move up over a very short time. We are still, though, above the 100 and the 200-day moving averages, which is a very, very positive sign, given we really haven't had a look above there since sort of like September. So keep an eye on natural gas, and things should start getting a bit more interesting if 315 breaks, the next target obviously being around this 338.20 region. So have a look at Brent crude. After a frisky end last week, it's actually been pretty darn quiet on the oil front. We have an OPEX and non-OPEX meeting on the 20th of November. The 30th of November, where they will almost certainly decide to extend the production cut all the way through to the end of 2018. We have seen oil race higher and sort of touch nearly 65, just failed above it. Interestingly, though, since we hit these highs, we've then had a series of lower highs, and we seem to be having a topping formation, which I've drawn on here. We've got a double top here at 64.874 on my chart. Let's call it 64.9. We have another double top at 64.5. And then we have nearby support now at this 62.70 level. Now, I'll draw your attention down here to the RSI. I've been going on about this, as most of you know, for most of the month now. Very, very good indicators of overbought and oversold markets in the commodity complex, and almost certainly a very good leading indicators of corrections. And I've been calling this for a little while. Is this going to be an aggressive correction to the downside to take out some of that recent long positioning, or is it going to be a slow correction on the RSIs? If you look at circling down the bottom here, to be honest, I'm not quite sure. Initially, I thought oil was actually setting itself up for a pretty aggressive correction, perhaps all the way down to this key support here around 60.10, which coincides very nearly now with this trendline support at 59.75. So I did feel that once we did go through this 62.70, we did have the potential to drop possibly quite aggressively. The RSI does seem to be coming down, though, as oil continues to slowly come off, but actually really pretty much stay in a range and quietly consolidate its gains. If we were to continue to have a few more days of this sort of price action and it dribbled lower to around 62.0, something like that, this would take the heat off the RSIs actually, and that would possibly set us up for moves much higher. In the meantime, I guess the rest of the week will give us an idea about that one. We have longer term trendline support here around 57, and it's actually quite hard to get bearish on Brent, on a longer term basis until this 57 region breaks and we have a daily close below it. Above I have to squash the chart up. Our next region of resistance is around the 69 area, and I need to squash the chart up to show you what I actually mean here. Just bear with me for a moment. The reason I'm saying that is mainly due to this level here, which was May 2015, where we saw a lot of work done between the sort of 65 area and the 69 area before this Goliath sell-off. So really on the charts, there's no real technical resistance between that sort of 65 region and the 69 region, but we haven't managed to have a daily close above 65, and in fact, when you blow the price action up, we've actually failed ahead of it. 1, 2, 3, 4, 5, 6 times we've failed ahead of 65. So I think actually for now it is fairly formidable resistance. Let's quickly look at WTI. It's telling a roughly similar story, although it hasn't quite got the same topping formation. It has actually had 1, 2, 3, possibly 4 today, lower highs. Again, the price action is suggestive of some sort of consolidation and perhaps a weight of long positioning sort of selling out of these levels as we await new news to actually, or new inputs to perhaps see the rally continue. Again, a bit like Brent, we have a double bottom here this time at around the 56.15 area. I don't see a lot of support. I have some marginal support lines here that go way back off screen here, and I won't bore you with that. Just take my word for it at 54.5. We have this longer term uptrend line, which has got what 1, 2, 3, 4, 5 points on it, and I'm quite happy with that one. That one comes in at around 54.3, and actually, again, a bit like Brent, until we see a daily close below that level, it's hard to say that the bullish uptrend has ended in WTI either. The RSI here is still in seriously overbought region, but it has been coming lower. Excuse me. Again, like Brent, I'm actually not quite sure whether it's going to be a sort of a chaotic, somewhat gruesome drop all the way down to 54.5. That brings the RSI back out of overbought territory, or whether this slow decaying sideways trading will be enough to take the heat out of it. But again, I'll reiterate my warning. The RSIs have been extremely good indicators of impending corrections in the oil market, whether it's overbought or oversold, and I always pay attention to them. Okay, that's enough about energy. Let's get on to the softs now. Let's start with sugar. And this time it's Brazil that's giving us a bit of volatility in sugar, which I've managed to mess up there. Okay, so sugar itself has actually had a pretty good week. We can see a series of higher lows here, one after the other, after the other, after the other. Technicians love this sort of formation. Very, very positive formation. Overall, though, when we take a step backwards, we still see that we are locked in this 12.5, 15 range in sugar. And what we've done is we've moved to the top side. Positive things are that we broke through the 100-day moving average, consolidated, and then the sell down again held the 200-day moving average. The 100-day moving average. And we've actually tested it 3 times, and it's bounced off again. What's been going on in sugar? Well, mostly it's all about Brazil this week, and Brazil analysts have been busily dropping their forecast for the size of the 2018 sugar harvest. Markets are always forward-looking, trying to predict the future. We do it with very variable success, but looking into the future, a lower sugar harvest from Brazil should be positive for prices. There's also quite a squeeze on refined white sugar at the moment. So clearly around the world, we're having sweeter drinks and hardening our arteries. And that's been very supportive of sugar this week. Hard to say where the support is here. I mean, you could draw a line here and it comes in around 14.40 in the short term. I think seriously though, it's this 100-day moving average, which is held beautifully here. So I think this is a pivot level, and as long as we stay above it, then we should see sugar push on and test the upper side of this range. I would, however, draw your attention to the RSI. So if it goes into this white area, just be a little careful about being long in the short term, much like I say with oil. Popping over to corn. It's Brazil again. Corn and soybeans actually this week. We've had the opposite effect here. We see that corn dropped some 3% in one day at the end of last week. That wasn't a strong dollar. That was, in fact, and it nipped this incipient sort of consolidation to the top of its range in the bud. This is Brazil rain, actually, and there's been some very, very decent rainfall in certain areas of Brazil, which are huge corn and soybean production areas. It's giving optimum growing conditions for the Brazilian harvests, and thus there's been a huge upgrade in both corn and soybean harvests from Brazil, and that of course has had a fairly ugly effect on the US futures prices reflected by the CFD, even though it's cash. And we saw this massive drop last Thursday, and then some consolidation here. Again, though, in the bigger picture, if we squish it up, we are still in a 348, 329.50 range. It will be interesting if we get down through this area, though, because we have got a few lows around this 335.50, and that could see a bit of a spike lower. We'll have to wait and see about that rain in Brazil, won't we? Beans, again, as I said earlier, I mean, even more notable here, we've seen a spike higher. We've held this trend line beautifully after we broke out of this triangle. Somewhat disappointing reaction after that breakout. Came back down, but we've held this trend line beautifully all the way into early November. That sad story came to a happy story came to a very sad end, very, very abruptly again, with a huge drop in soybeans last Friday. And we gave back all of those gains, and actually we closed below this trend line, which I think is a really negative factor. Again, there's been some huge upgrades in the Brazilian harvests for soybeans next year, as those optimal rainfalls have made Brazilian conditions perfect for large yields. We closed a couple of times below that trend line, and then not only that, we've then fallen again by, and I would estimate that again at something like about 2%. We've fallen in one day in a straight line, and we've closed below this 100 and this 200-day moving average, yeah? And we have not regained it. For soybeans to continue higher again, or to actually recover, we must have a daily close above excuse me, above this 200-day moving average, this blue line here. Okay, so this is key now. If we close under here again today, that would imply that we are going to move back down towards this 949 area. So a bit of heartbreak there in soybeans, having broken out of its long-term ranges. We've now broken back down underneath that range. When we look at it in the big picture, we can see we've broken this trend line, which today is at 978.10. We've broken down through the 100 and 200-day moving averages. So not looking great for the beans, thanks to rain in Brazil. And finally to wheat. So wheat is suffering as well, not because of Brazil, which some of you may be happy to hear, but it's those Russians. The market is extremely worried about the size of these Russian harvests. Also, with a stronger dollar now and a weak ruble, that makes Black Sea wheat much more attractive for many buyers around the world, rather than that expensively priced in US dollars North American wheat. And that has been weighing on the wheat contract over the last couple of days. I don't see that situation changing. Perhaps most disappointingly, we've gone down through the 200-day moving average. We've been up, we've had a half-hearted test, fell, and then we've failed even further away this time. So we've got nowhere near this 200-day moving average, which is at 4.30. The danger is definitely to the downside. We have around a double bottom at 404, and then this key 393.10 level Above, of course, we have that previously mentioned 200-day moving average, 100-day moving average at 437.25, and then the top of the range at 439.00. So a lot of wood for wheat to chop, so to speak, shaking the bushels in order for this market to turn bullish again, I'm afraid. So for now, we do seem still stuck in a range on wheat, but maybe we are about to go and test the downside of that range, thanks to the danger, shall we say, that the Russian wheat market now poses to the North American export side of things. Righto, that's enough from me. I hope you have enjoyed this, and I wish you a wonderful week's trading, and we'll speak next week. Thank you for listening, and goodbye.